Um, corrections in the forex market can again be counter trends, and as I mentioned earlier, they can also transition into a newer trend. And so, what is the definition of or at least my definition of a counter trend? And my definition of a counter trend is this: a counter trend is a move against the major trend that has the potential to be more substantial in terms of pips than a normal correction. There are some clues that the market gives, and I'm big on clues. I'm big on clues to figure out when the market may trend and when the market may counter trend as well. And there's clues in the market that will allow us to anticipate a counter trend. And one those clues is the longer a trend in time and in pips, the more significant is the counter trend potential. So the longer a trend in time, extended trend period that takes a certain amount, a longer period of time that is directional, that is fast, that is moving in a definitive trend to the downside or a trend to the upside. Another clue that I look for to anticipate a counter trend is if a significant trend, a significant move from either high to low or low to high, does not have a correction of at least 38.2 along that trend. So when you have the potential for a counter trend, there are a couple things that you need to do that are important in order for you to gear your mind toward trading this counter trend. And the first thing is important to put the potential counter trend into perspective. And by that, what I mean is how far in pips can the counter trend actually go? And you do this by applying a Fibonacci retracement. So sort of led up to that. I kind of gave you a little hint in regard to that earlier by discussing that 38.2% Fibonacci retracement. We'll get to that in a second. When it's another thing that is important to do when you're in the potential for a counter trend is to put the potential move into a time perspective, And again, I'm going to get into that in just a second. And the final thing that you need to understand when you start to think about trading the counter trend is that it is important to have a reason to trade the counter trend. And if that reason fails, you need to get out. Why? Because trends are fast, trends are directional, and you don't necessarily want to fight the major trend. What you're trying to do is anticipate a counter trend, but that doesn't necessarily mean that it's going to pan out. But if you have a reason, and what I mean by reason is a technical reason to trade the counter trend, then you have a reason to get out of that counter trend, and I'll go through that as well. So let's go into and take a look at some of the charts and to kind of put these ideas that I've told you into perspective from looking at the actual charts, looking at some examples as to what I mean. So what we have here, this is probably the granddaddy of all of moves to the downside, or at least in recent memory here, of the euro versus U.S. dollar. The euro was hit consistently from this high going back to 151.44 was a high that we reached November of 2009, and the market trended and trended and trended and trended down, and we reached a low of 118.76 on the June 7th, 2010. Now, the thing about this trend here, and one of the clues that I have in regard to the possibility of a counter trend is to go back in time and look to see what the corrections did at each of the levels along the way. And if you look at this chart and you put the Fibonacci up here at the top at 151.44, and you start to go from correction level to correction level, I want you to pay attention to this 38.2% correction line right here. And remember, I said earlier that if the market doesn't correct more than 38.2% during this trend move to the downside, it's more of a candidate for a counter trend correction, just by the virtue of the fact that it's gone a long way and we haven't had a major correction along the way. And and also the time factor of the trend is also of a significance. In this case, the euro dollar trended for a period of about 7 months to the downside, down, 7 straight months with no real pause along the way. So let's take this Fibonacci and let's move ourselves down from each of the corrective lows and see if we get anywhere near 38.2. Now, the first correction actually comes up to 38.2% correction, but that's because we're just at the beginning, and you can see that we went below. This is my 100-day moving average. This is my 200-day moving average. These are the moving averages that I use on a basis here. And what we see here is that at the beginning of the trend, it's not hard to get to 38.2. What I'm looking for, so I often discount that first move. I know there's always these exceptions to the rule, but in this case, I'll always give a free pass order to the first one, but even in this case, the market only went 38.2 and then started to move back down. If you come to the other lows, do we get near the 38.2 line? No, we're not anywhere near that 38.2. When we come to this point right here, this other low right here, do we get anywhere near the 38.2? No. When we come down to this low, do we get anywhere? No. Do we come down to this point? This is a 500 pip correction. Do we get anywhere near 38.2? No. When we come down to this point right here, we don't get anywhere near, and don't get that low at 118.76. And we don't know where this market may correct, but we can start to think in terms of, let's see if there's a reason to think that the market has a potential to correct higher and have a significant correction to the upside, perhaps even a counter trend move. So in analyzing whether this is possible, remember I said you need a reason to do the trade. You need a reason to change your bias off this chart from being so bearish to bullish, and off of things like tools that I use like the moving averages. We're not anywhere near the moving averages at all in this chart. As far as retracements, we know that we're not near the 38.2% retracement. In fact, we're still trending to the downside. Now, there are some other clues here off of this daily chart, which I do want to point out that you could possibly grasp on and think in terms of, I have a reason to be bullish, and if I have a reason to be bullish, I also have a reason to exit the trade if the trade doesn't go well. And what I want to point out is this area right here around the 121.50 level. If you look at these lows on this daily chart during this period right here, we can count a number of times. Actually, the low range was 43 to 66 in this range. I'm going to discount this move to the downside. We went to the 11 and we bounced quickly back up to the upside. It was a rejection, a pure rejection of this break of this trend line. But if you look, or this what I call this remembered line. But if you look at this move, you can count 1, 2, 3, 4, 5, 6, 7 different bars here where the market came down to that's around the 121.50 level and had a bounce.